So, as we all expected, for the past 4 to 5 months, the Federal Reserve has cut the interest rate from 4.5% to 4.25%, and I think it's a good time for us to refresh our view on the market. Today, I'll provide an update on the market, but expanding from there, I'll also do a thorough recap on how our view on the market has evolved in the past 9 months or so, and try to see how we should position ourselves for the upcoming months. Okay, let's look at the key data that came out first. There are a lot of data I want to cover, so please bear with me. S&P Manufacturing PMI for August, 53 versus 53.3 forecast versus 49.8 last month. ISM Manufacturing PMI for August, 43.8 versus 45 forecast versus 43.4 last month. S&P Global Services PMI for August, 54.5 versus 55.4 forecast versus 55.7 last month. ISM Non-Manufacturing PMI for August, 52 versus 50.9 forecast versus 50.1 last month. ADP Non-Farm Employment for August, 54,000 versus 73,000 forecast versus 106,000 last month. Non-farm payrolls for August, 22,000 versus 75,000 forecast versus 79,000 last month. Unemployment rate for August, 4.3% versus 4.3% forecast versus 4.2% last month. Core CPI year-on-year for August, 3.1% versus 3.1% forecast versus 3.1% last month. CPI year-on-year for August, 2.9% versus 2.9% forecast versus 2.7% last month. Okay, so looking at the data, we can make a few conclusions. Number one, the manufacturing industry is showing a somewhat mixed performance. Number two, non-manufacturing industry, which is a much larger portion of the US economy, is still resilient. Number three, there are less jobs being created, and therefore non-farm payrolls barely changed. Number four, however, the unemployment rate still remains very low despite the low number of jobs created. Number five, inflation is still high, but within the expectations. Okay, so based on the data we're looking at today, the Fed decided to cut the rates. Now, as I said multiple times, this is a very weird decision given, number one, inflation is still high, number two, unemployment is very low, and number three, services sector is still resilient. With those three conditions, it makes more sense for the Fed to increase the rates. However, the Fed decided to cut the rates. Now, why is this? Let's try to recap what we talked about in our previous videos. In my last video, I explained that there were strong conflicts between Trump, Bessent, and Powell on the interpretation of, number one, the unemployment rate, and number two, the inflation. Now, first on the unemployment, going back to our data, Trump and Bessent were basically looking at the number of jobs being created. If we look at the non-farm payrolls number for August, only 22,000 jobs were created, which is severely lower than the 75,000 forecast. Trump and Bessent were arguing that given the small number of jobs are being created, the Fed needs to lower the interest rate to create more jobs. Powell, on the other hand, was looking at the unemployment rate, which was still very low at 4.3%. Given the low unemployment rate, Powell was arguing that there's no room to cut the rates. However, in my last video, I noted that Powell basically caved in to Trump and Bessent at the Jackson Hole, saying that the labor market is currently at a curious kind of balance, which may become vulnerable anytime soon. Okay, next on inflation, I noted that Trump and Bessent were of the view that the tariff only has a one-off impact on inflation, and not lowering the rates because of the concerns over tariff is not fair. Powell's view was that the tariff impact on inflation is something which takes time for us to understand, and lowering the interest rate now is not a smart thing to do. On the inflation, I noted that Powell changed his stance at the press conference in late July. He admitted that the base case impact of the tariff on the inflation is most likely a one-off event, which is basically siding with Trump and Bessent. Okay, so basically, those are the reasons why the Fed cut the rates despite a high inflation, low unemployment rate, and resilient economy. I also noted that Trump's actions against the Fed, replacing Kugler with Myron and trying to replace Lisa Cook, is also playing a role in shaping the Fed's rate decisions. As I said in my previous video, these kind of actions which Trump and the Treasury is taking against the Fed may potentially negatively impact the market's credibility towards the Federal Reserve's monetary policies. Okay, so everything aside, what happened has happened. So let's try to assess the market based on where we are today. I want to lay out a few positives and negative observations based on the current market. Now, first on the positives. Number one, we're now on a rate cut cycle. Number two, inflation is somewhat within the band of expectations. Number three, economy is still doing okay, at least on paper. Number four, job market is stable, at least on paper, though the balance is curious. Number five, corporate earnings, especially the big techs, are generally outperforming. Okay, next on the negatives. Number one, rate cut despite high inflation and low unemployment is weird. Number two, forward price to earnings of big techs are back at around 30 times, which is quite high. Number three, the market already seems to be pricing in 2 more rate cuts within the year. Number four, I'm not sure whether tariff impact on inflation will just be a one-off. Number five, the trajectory around weak dollar may push inflation higher. Okay, so as you can see from my perspective, there are as many positives as negatives and as many negatives as positives. So the positives are quite straightforward, so I won't go into the details around those. Basically, the reason current market can be positive is because the economy is doing well with a balanced job market, high earnings, and no surprises on the inflation. But the rate is also coming down lower. This basically means that the Fed put is there for the market even when the market doesn't really need it. So these are straightforward. Now, on the negatives, let's try to look into each of them. Number one, rate cut despite high inflation and low unemployment. Now, the reason this can be viewed as a negative is because cutting the rate basically means that the Fed is trying to ease the market and provide more liquidity in the system. Now, when the inflation is already high and unemployment is already low, cutting the rates can cause a lot of problems. Number one, it could easily push the asset prices higher. And number two, given the low unemployment rate with people having decent spending power, it could easily push the prices of goods higher, i.e. more inflation. And number three, the Fed's monetary policy can lose credibility. Now, this could lead to a stagflationary situation, intensifying the higher asset prices as well as high inflation, which could ultimately lead to the Fed either stop cutting the rates or even increasing the rates down the road. Number two, forward price to earnings of big techs are back at around 30 times, which is quite high. Okay, so since early April lows, when the big tech valuation fell to around 20 to 25 times forward price to earnings, the valuation level is now back to where it was at around 30 times. Now, the good news was that the earnings release of most of the firms were positive surprises, so the forward price to earnings ratio didn't go up as much as the share price increase, given the earnings, which is the denominator, were also adjusted higher. However, 30 times price to earnings valuation is still quite high compared to our historical average levels, which can act as a psychological hurdle for the market. Number three, the market already seems to be pricing in 2 more rate cuts within the year. Now, this is an important point which basically shows how much the market is counting on the Fed put. As I explained in my previous 3 put problems video, the market is counting on the 3 puts, which are Trump put, Treasury put, and the Federal Reserve put. However, with the Trump put and the Treasury put running out of steam, the market is desperately looking to depend more on the Fed put, which is shown on the Fed rate probability scenario. According to the Fed Watch, basically the market is currently assuming that there's over 70% chance of 2 more rate cuts within the year, which is a pretty big leap of faith. Now, I don't want to speculate on how many more rate cuts there will be within the year, but it is pretty obvious that the market is pricing in a strong positive monetary policy outlook already. Number 4, I'm not sure whether the tariff impact on inflation will just be a one-off. Now, it seems pretty obvious that Trump, Bessent, and Powell have agreed that tariff will be a one-off impact on the inflation. However, while this is theoretically and mathematically correct, it is not really the case in the real world. One good example is what happened in 2018 around washing machines. In 2018, the US imposed 20 to 50% tariff on washing machines. The problem was that, for some reason, while no tariff was imposed on the dryers, the price of dryers also increased by around 12%. What happened was, because so many retailers were bundling washing machines and dryers, as time went by, the inflation pricing on the washing machines spreaded to the dryers as well. At the end of the day, the consumers ended up paying higher prices for both products. Now, the lesson here is that math doesn't always work when it comes to the economy. While the government and the Fed is assuming that the tariff is a one-off impact, we'll need to see whether it really ends up that way. Number 5, the trajectory around weak dollar may push inflation higher. Now, as you all know, Trump and Biden are pushing for a weaker dollar. This is to partly boost the US's export, impose more inflationary pressure on the imported goods from other nations, and also, while they don't explicitly say so, continue to drive the asset prices higher to potentially protect consumer confidence levels. Now, the problem with this strategy is that while the weaker dollar may do all those things, coupled with the tariff, it may lead to a high inflation across all goods. Now, the weaker dollar will most likely directly impact the imported goods coming into the nations, but as I explained just now on how tariff may not be a one-off thing, it may be the same for the domestically produced goods as well. If the price of one good goes up, it may lead to a higher pricing pressure for other goods as well. Okay, so those are the summary of the positives and the negatives on the market at the moment. Now, let's move over to the more important topics, the predictions and implications. Now, while it's very difficult to project how the market will move based on the current situation, let's try to come up with the most rational scenario. Now, in order for us to come up with the predictions, we'll need to fully reassess how we made our decisions until today. Okay, so from November of 2024 until early April of 2025, I've repetitively been saying that we should be extremely careful in buying into the stock market, given we're in the most illiquid period. Let's look at our Federal Reserve chessboard again. So I explained this chessboard in my How to Get Rich just by looking at Fed policies video. To explain the chessboard one more time, basically I explained that there are two key metrics to look at to determine the best time to invest. The first metric is the Federal Reserve policy rate, which is the interest rate, and the Federal Reserve balance sheet. The best time to invest is when the interest rate is going lower and the Fed balance sheet is increasing. The worst time to invest is when the interest rate is going higher and the Fed balance sheet is decreasing. Okay, so the reason I said we should be careful is because of the following reasons. Number 1, the Fed was going through a quantitative tapering, which was a minus to the market liquidity. Number 2, the Fed was giving absolutely no indication on cutting the rates. Basically, I was saying that we're in Section D market with the Federal Reserve's chessboard. Number 3, up until January, the valuation of big techs were at over 30 times forward price to earnings, which was very high. Number 4, Trump was about to start his second term as the president, which acted as uncertainties. Number 5, the inflation remained high and sticky, which meant that there could be more liquidity contractions. Okay, so those were my rationales. However, in early April, I finally changed my stance and told you guys to start buying into the market. The changes in my previous stances were for the following. Number 1, regarding the Fed going through the quantitative tapering, this was still true. However, tapering speed was slowing. Number 2, on the rate cuts, Trump's push towards a rate cut was getting serious and the market was gradually expecting a rate cut within second half of 2025. Number 3, on the valuation of big techs came down to 20 to 25 times a forward price to earnings ratio level, which was a lot more comfortable entry point. Number 4, on Donald Trump, uncertainties were removed. We saw the tariff chaos, but political noise generally goes away quite quickly. Number 5, on the inflation, while inflation is still true, no one seemed to care about inflation anymore given Trump's narratives. Okay, so basically what I was saying is that the Federal Reserve chessboard was gradually shifting from Section D to Section C, where things are getting a bit more liquid, valuation level is more reasonable, political uncertainties are now removed, and inflation is less of an issue now given no one cares anymore. Okay, so those were my rationales. From early April until my last market update, I have continuously been giving the same message. keep buying into the market whenever the market shows small to modest corrections. Now, for those of you who have been buying more into the market during the past 5 months or so, I'm sure you have now accumulated quite a bit of position in the market. Okay, so based on where we are now, what should we do now? Now, in order for us to have a view on the market, we need to reassess everything again based on where we are. Okay, first on the Federal Reserve's balance sheet. The balance sheet is still contracting. Based on the latest trend, there seems to be a bit less of a pattern from the Fed on how much they're decreasing the balance sheet, but the trend is clear. Next, on the interest rate. We now have a more clear view on where the interest rate is heading. Interest rate is now starting to go down, so I believe it is fair to say that we're now more clearly in section C of the quadrant. Now, on the valuation, as I said previously, valuation has now come back up to where it was at around 30 times the price to earnings for big techs, so we can't be too comfortable with the valuation now. Next on the political point, I believe this issue is now a double-edged sword. However, I do believe that there won't be anything as radical as what happened between February and April. On the other hand, I do think there could be some more positive news coming out on this front, whether the likes of revoking some of the tariffs imposed on some countries, though not completely. Okay, so to summarize, this is what I think of the current situation. Liquidity situation in terms of the Fed's monetary policies is somewhat neutral. Valuation is high. Political uncertainties are still there, though not to the extent it existed early this year. So overall, I think things are generally neutral, while valuation is a one negative aspect outstanding in the current market. Also, although nobody cares, I'm still a bit concerned about the inflation. As I noted, tariff may not end up being a one-off impact on the inflation, and depending on how much the dollar weakens further, the inflation situation may worsen a lot more. So in short, my one-line summary on the market is, things are generally neutral to the market, while there are some concerns over valuation and inflation. Okay, so considering where things are, I personally would do the following. Number one, the position I accumulated in the past 5 months are now quite sizable and is deeply in the money. Now, despite the outstanding risks, I do not plan to sell any of my positions. Now, let me try to explain this. Whenever the market is in the early days of moving from an illiquid period to a more liquid period, i.e. moving from section D to section C or section B, selling your positions can be very dangerous as the liquidity trajectory doesn't change in a very short period of time. There's a chance that the market acts irrational and continues to move higher for longer on the back of the falling interest rate, and miss out on this rally after accumulating your positions can be very dangerous. Of course, the market can crash all of a sudden despite the falling interest rate. This happened in 2000 and 2008 during the dot-com bubble and the Lehman crisis. However, I do want to note that these kind of events only happen when there are fundamental and structural problems in the market. As of today, the only structural issue we have is the inflation, but given we already went through an inflation crisis already in 2022, I would believe that a similar event happening anytime soon would be a remote scenario. Number two, now, while I'll not sell any of my existing positions, I'll now refrain from buying more into the market. Now, since early April and until my last market update video, I consistently said that I would buy more into the market whenever the market showed some mild corrections, which I did. However, from now on, I would stop buying more into the market and just monitor the market very closely with the positions I have. I'll start buying more only under one condition. I'll only buy more when the big tech's forward price to earnings ratio falls to around 25 times or so. Now, there could be two ways of this happening. Number one, the market can just go through an inorganic correction due to external factors like the inflation or more geopolitical noises. Or number two, the market may stay still or continue to go up, but the big tech's earnings may outpace the market so that the price to earnings ratio falls to a lower level. Now, unless one of the two scenarios happen, I'll not buy more into the market. But if any of the two scenarios happen, I'll happily buy more. If it doesn't happen, I won't miss out on the market either, given it would mean that the market is continuing to rally with the positions I already have. Okay, so those are the things I wanted to cover today. Now, please be reminded that everything I said are my personal opinions, and I'm sure all of you may have different perspectives given we have been monitoring the market together for quite a long time now. I'll say one thing though. The market today is a very confusing one, and all indicators are pointing towards different directions. As I say all the time, it is our job to make the best judgment based on the current circumstances, and I hope all of you do the same for yourselves. After all, I only wish all of you the best. Always. I hope you enjoyed the video, and I'll be back with more videos very soon.